You know, a lot of people spend their entire lives chasing financial freedom. They wake up early, rush to work, spend long hours under fluorescent lights, and count the days until the weekend. But what if I told you that with the right investment mindset, just $50,000 placed in the right asset, like the S&P 500, could eventually outperform your full-time job? That's not clickbait, it's math, it's patience, and it's the power of compounding working quietly behind the scenes. Now, before we get into the details, let me make one thing absolutely clear. This isn't financial advice. I'm not your financial planner or your accountant. I'm just someone who's walked the same path of wanting more out of life than a paycheck every 2 weeks. This video is purely educational, and maybe a little motivational, because the truth is, most people underestimate what consistent, disciplined investing can do over time. So, let's dig in. There's something magical about hitting that $50,000 investment mark. It's not just a number, it's a mental and financial milestone that changes how you think about money forever. When you start investing, the first few thousand feels slow. You put in money every month, but the growth seems microscopic. Then one day, you check your portfolio and see it's worth $50,000. That's the turning point. You're no longer just saving money, you're owning assets that are working for you while you sleep. Now imagine if that $50,000 wasn't just sitting in a bank account losing value to inflation but was instead growing inside one of the most proven investment vehicles on Earth, the S&P 500. Let's start with what VOO actually is. VOO is Vanguard's S&P 500 ETF, a fund that holds shares of the 500 largest and strongest companies in the United States. We're talking about the biggest names that shape the global economy, companies like Apple, Microsoft, Amazon, and Johnson & Johnson. When you buy a single share of VOO, you're essentially buying a tiny piece of every one of those 500 businesses. It's diversification in its purest form. And that's the beauty of it. With one simple purchase, you own a slice of the American economy. Whether technology thrives, healthcare expands, or consumer goods dominate, you're always benefiting from the collective success of these companies. That's why VOO and other S&P 500 ETFs are the cornerstone of so many investment portfolios. They remove the guesswork. Instead of asking, which stock will win, you're saying, I'll just own them all. Now let's talk about risk. Buying individual stocks can feel exciting, but it's risky. If you put your entire savings into one company, say Tesla or Netflix, and it drops 40% in a bad year, you're in trouble. But with an ETF like VOO, your risk is spread across 500 companies. One stock's bad day is barely a blip on your radar. That's the safety net diversification gives you. Let's take a simple comparison. Suppose you bought Tesla 5 years ago. It skyrocketed. Amazing. But what about the person who bought it last year? They might have lost money. The S&P 500, on the other hand, has been far more consistent, averaging around 10% annual returns since it was first tracked in 1957. That's nearly 7 decades of history backing it up. Here's where things get really exciting. Let's say you invest $50,000 in VOO today and never add another dime. Based on the S&P 500's historical average of around 10% annual growth, that money could grow to over $620,000 in 25 years. But if you let it sit for 35 years, that same $50,000 could become over $1.7 million, without you doing anything else. That's the power of time and compound growth. Albert Einstein supposedly called compound interest the 8th wonder of the world, and once you see how it works, you'll understand why. Every year, your investments earn returns. Then those returns start earning their own returns. It's a snowball effect. The longer it rolls, the bigger it gets. Now, let's talk about one of the most overlooked aspects of VOO, its dividends. VOO's dividend yield is typically around 1.3%, which some people think is small, but that's because they don't understand what's really happening. That low yield isn't a weakness, it's a sign of strength. It means the share price has been growing so rapidly that it's outpacing the dividend growth rate. In reality, the dollar amount of dividends paid per share keeps going up year after year. The companies inside the S&P 500 have a long history of increasing dividends as their profits grow. When you reinvest those dividends instead of cashing them out, something magical happens. Your portfolio doesn't just grow, it compounds faster. You buy more shares with each payout, and those new shares start earning dividends too. That's how long-term investors quietly build wealth without needing to chase the next big thing. Here's another reason VOO stands out. Its cost. VOO has one of the lowest expense ratios in the world, just 0.03%. That means for every $10,000 you invest, you're paying only $3 a year in management fees. Compare that to many mutual funds or actively managed ETFs that charge 1% or more. Over decades, that difference could mean hundreds of thousands of dollars staying in your pocket instead of going to a fund manager. When it comes to investing, fees are like hidden taxes. The lower you keep them, the faster your money grows. So why is the $50,000 milestone so important? Well, it's not just about the number, it's about the mindset. Reaching $50,000 proves you're capable of saving, investing, and committing to a financial plan. It's kind of like reaching base camp before climbing Everest. Once you hit 50,000, your confidence really skyrockets. You realize you're not just participating in the economy, you actually own a piece of it. You start to understand how the market works, how dividends flow, and how patience really pays off. That's when people start getting serious. They begin setting new goals, 100,000, 250,000, even $500,000. And with each milestone, compounding accelerates even faster. Now let's talk about the part that gets everyone's attention, how $50,000 in the S&P 500 could eventually outperform your full-time job. If your VOO investment continues to grow at 10% annually, and you keep reinvesting your dividends, your total wealth just keeps accelerating. Now if you also contribute a modest $300 per month, about $10 a day, you're looking at over $1 million in 25 years, and nearly $3 million in 35 years. Think about that for a moment. With consistent investing, that $300 a month could someday replace your job's salary entirely through passive income. At that point, you're no longer working for money. Your money is working for you. So, how do you actually get to that first $50,000? Here's the truth. It's not about luck or timing the market. It's about discipline and making smart financial choices. Cut unnecessary expenses. That means cooking at home instead of eating out, driving a reliable used car instead of a flashy new one, and avoiding high-interest debt. Automate your investments. Treat investing like a bill you have to pay every month. Set up automatic transfers into your brokerage account, so you don't have to rely on willpower, dollar cost average, or DCA. Instead of trying to time the market, invest consistently, whether prices are up or down. On red days, you'll buy more shares at cheaper prices. On green days, your portfolio will grow faster. Either way, you win. Every time you buy during a dip, you're essentially getting the same high-quality companies at a discount. That's how long-term investors build serious wealth. Let's take this a step further. Imagine using a dividend calculator to project how your investment grows. If you start with $50,000 in VOO and assume average dividend growth of about 6% per year, in 30 years, your portfolio could generate over $6,500 per year in dividends alone, without selling a single share. But if you keep investing, say $300 a month, that number skyrockets. After 30 years, your portfolio could be worth over $2 million, paying more than $10,000 annually in dividends. That's income you could live off of. And if you follow the common 4% rule for withdrawals, that $2 million portfolio could provide $80,000 a year in passive income, plus dividends. That's over $100,000 a year of total income from your investments. That's how you replace your job, not through luck, but through consistency, patience, and time. Here's the painful truth. Most people never reach that point, not because they can't, but because they quit too early. They get scared when the market dips, they panic sell when headlines scream recession, and they stop investing when times get tough. But the people who win, the real, long-term investors, understand that volatility is normal. Dips are opportunities, recessions are temporary, growth is inevitable. If you can stay the course through the rough times, you'll look back one day and realize those downturns were the moments that built your fortune. At the end of the day, building wealth through investing isn't about chasing fast money. It's about developing the right mindset. You need to think long-term, stay calm under pressure, and believe in the process. You have to view every dollar you invest as an employee, working tirelessly for you, day and night, without asking for a raise or a break. The more of those employees you hire, the faster your financial machine grows. That's the mindset difference between people who dream about financial freedom and those who achieve it. Alright folks, let's take a moment to recap everything we've covered today. VOO, as you know, tracks the S&P 500, giving you that instant diversification across the top 500 US companies. It's low cost, with a microscopic 0.03% expense ratio. And it offers reliable growth and dividends, averaging around 10% annual returns over the long haul. Now, imagine this. A $50,000 investment could grow to over $1.7 million in 35 years, and by adding just $300 a month, you could push that number past $2 million, generating over $100,000 a year in income. This isn't a get-rich-quick strategy, folks. It's more of a get-rich-for-sure strategy, if you stay disciplined, patient, and focused. Because honestly, investing isn't about predicting the next big thing. It's about buying great assets, holding on to them, and letting time do the heavy lifting. And that's the beauty of the S&P 500. It represents the heartbeat of the American economy, its innovation, its growth, and its resilience. If you commit to investing consistently, reaching that $50,000 milestone is just the beginning. From there, compounding takes over. Dividends start working in your favor, your wealth begins to snowball, and one day, you might look up and realize your portfolio has quietly surpassed the salary you used to depend on. That's when you know you've truly won the money game. Because the goal isn't just to work for money, it's to build a life where your money works for you. Reaching $50,000 invested in the S&P 500 isn't the end of your journey. It's the start of something much bigger. It's the moment you stop chasing money, and money starts chasing you. Once you hit that milestone, something inside you shifts. You start to understand wealth differently. It's no longer about working harder, it's about working smarter. You begin to realize that every dollar you invest is quietly compounding behind the scenes, multiplying while you sleep, and building a version of freedom most people only dream about. You know, at first, investing feels like a grind. You're putting money away, watching the market bounce around, and sometimes you wonder if it's even worth it. But then, one day, you log into your brokerage account and realize your portfolio made more in a single week than you did at your job that month. That's when it clicks. That's when you realize the true power of ownership. You're not just saving, you're buying time. Every dollar invested today is buying back hours, days, even years of your future. And that's what makes the S&P 500 such an incredible foundation. It's not about chasing overnight success. It's about letting consistent, long-term growth do the heavy lifting for you. If you take away only one lesson from all of this, let it be this: consistency beats intensity every single time. It doesn't matter if you can only invest $50 a week or $500 a month. What really matters is that you do it regularly. The market rewards discipline, not timing. Think about it. Someone who invests steadily through the highs and lows ends up owning more shares at lower average costs. That's how wealth quietly accumulates in the background. You can't control the market, but you can control your habits. You can automate your deposits. You can resist the temptation to pull your money out when prices fall. That's how real investors win. It's easy to feel impatient. The early years of investing feel slow, sometimes, honestly, painfully slow. You're contributing month after month, and your balance barely moves. But that's the deceptive part of compounding. It's front-loaded with boredom and, back-loaded with magic. The first few years are just preparation. The next few decades are where the real growth happens. It's kinda like planting a tree. For a long time, nothing seems to happen. Then suddenly, one year it grows taller than your house. People quit right before the growth takes off. They see a dip, panic, and pull their money out, just before the recovery. That's the biggest tragedy of investing. Not losing money, but losing patience. If you can push through those early years, if you can ignore the noise and stay consistent, you'll see results that almost feel unreal. Let's be honest, investing isn't always easy. The market will test your patience, your confidence, and sometimes, honestly, your sanity. There will be days when the headlines scream, crash, and your portfolio drops thousands of dollars overnight. You'll question your decisions. You'll wonder if you should have just kept your money in cash. But then, a few months later, the market bounces back, stronger than ever. It always has. That's why successful investors don't react emotionally. They prepare mentally. They understand that volatility isn't danger, it's opportunity. When prices fall, you're buying the same great companies at a discount. and when they rise again, your future self will thank you for being brave when others were scared. There's a certain elegance in keeping your investing simple. You don't need to chase crypto, penny stocks, or risky startups. You don't need to spend hours reading complicated charts or following financial influencers shouting predictions. All you need is a long-term plan, and a vehicle like the S&P 500 that represents the backbone of the US economy. Every major market dip, every recession, every panic, history shows that the S&P 500 has recovered and gone on to reach new highs. Every single time. So instead of trying to outsmart the market, align yourself with it, own the index, hold it, let time do what it's always done. Let's talk about what really accelerates your growth: dividend reinvestment. When the companies inside the S&P 500 pay dividends, you have two choices: take the cash or reinvest it. Smart investors reinvest. Here's why. Those dividends buy you more shares, and those new shares produce their own dividends. Over time, this creates a self-fueling engine of growth. Imagine planting a tree that drops seeds every year, and each seed grows into another tree that also drops seeds. That's dividend reinvestment in a nutshell. It's how ordinary people with modest incomes build extraordinary wealth over a few decades. Let's visualize this. You start with $50,000 in VOO. You add $300 every month. That's it. No complicated trading, no guessing the market, just consistent contributions. After 25 years, your portfolio is worth over $1 million. After 35 years, it's nearly $3 million. At that point, you're not just an investor, you're financially independent. The dividends alone could cover your monthly bills, your mortgage, even your travel budget. You could choose to work because you want to, not because you have to. That's real freedom. So how do you actually live off your investments? That's where the 4% rule comes in. The 4% rule is a simple guideline many financial planners use. It suggests that if you withdraw 4% of your portfolio each year, your money should last indefinitely, even accounting for inflation. So if your portfolio is worth $2 million, 4% equals $80,000 a year. Combine that with your dividend income, and you could easily have over $100,000 a year in passive income. That's enough to cover most lifestyles comfortably. And you're not even touching the principal. Your money keeps growing, and you keep living life on your own terms. At some point, the numbers stop being the goal. The focus shifts from, how much can I make, to how free can I become. Financial freedom isn't just about having millions in the bank, it's about waking up without anxiety. It's about having the time to pursue what matters: family, creativity, health, peace. When you stop worrying about bills, your entire mindset changes. You make better decisions. You become more patient, more confident, more generous. And all of that starts with a few simple, consistent choices, like investing that first $50,000. Staying consistent for decades takes more than math. It takes motivation. Here are a few mental strategies that help. First, track your progress visually. Watching your net worth grow, even by small amounts, keeps you focused. Second, celebrate small wins. Every milestone matters. Your first $10,000, your first dividend check, your first year without panic selling. Third, avoid comparing yourself. Everyone's financial journey is different. Focus on your goals, not someone else's highlight reel. And finally, remember your why. You're not investing just to make money. You're investing for freedom, peace of mind, and the ability to live life on your terms. Once your investments start to grow, protecting them becomes just as important as building them. That means keeping your portfolio diversified, not just within the stock market but across different asset classes, like bonds, cash reserves, or even real estate. It means avoiding high-interest debt that can eat away your returns. And most importantly, it means having patience. The longer you can keep your money compounding, the more unstoppable your growth becomes. If you look at history's greatest investors, people like Warren Buffett, Jack Bogle, and John Templeton, they all shared one thing in common: they trusted time. They didn't jump in and out of the market. They didn't try to outsmart short-term trends. They simply invested in great companies, stayed the course, and let compound interest do the rest. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient," and that's exactly what the S&P 500 rewards: patience. Something interesting happens as your wealth grows. You stop thinking in terms of dollars and start thinking in percentages. A 10% annual return on a $10,000 investment is $1,000, but a 10% return on a $1 million portfolio? That's $100,000. Same percentage, very different lifestyle. That's the exponential magic of compounding. It starts small, then suddenly it feels unstoppable. The hard part isn't the math, it's staying in the game long enough to experience it. Here's something people rarely talk about: the same patience and discipline that builds financial wealth also builds personal wealth. When you commit to investing, you're also building habits, consistency, focus, delayed gratification. Those habits spill over into every area of your life. You become more strategic, more thoughtful, more grounded. You start to realize that success in anything, business, relationships, health, comes from the same principles as investing: patience, consistency, and belief in the long game. So while your money compounds, you do too. When you finally reach that point where your investments can cover your life, it's surreal. You wake up one morning, open your brokerage app, and realize your portfolio just grew by more overnight than your paycheck used to be in a month. That's when you understand the phrase, let your money work for you. You're not chasing promotions anymore. You're not stressed about bills or overtime. You're free to build, to create, to enjoy. And it all started with that first $50,000. The millionaire version of you already exists in the future. The only difference between now and then is time and consistency. Every dollar you invest brings you closer. Every dividend payment, every reinvested cent, every market dip you endure, it's all part of that journey. So, keep going. Keep investing. Keep believing. Because the moment you decide to own your future instead of renting it, that's the moment you've already won. If you made it this far, remember this: financial freedom isn't a fantasy, it's a formula, and the S&P 500 through something as simple as VOO is one of the most proven ways to get there. Stay consistent, stay patient, and let time do what it does best. Turn small seeds of effort into a forest of freedom, because $50,000 isn't just money, it's momentum. And once that momentum starts rolling, it's nearly impossible to stop.